Historically, US equity markets have often put in a major low around the month of October. The Dow Industrials has apparently had its best month in 50 years, and US GDP has had a decent rebound from the soft patch of the first two quarters of 2022. Does that mean that the equity lows are in, or has 2022 just been the precursor to a proper recession and new equity lows that might materialise in 2023? That's the big conversation. In early October this year, we looked at some of the call buying strategies that institutions were implementing in order to hedge their equity underweight. Bearish sentiment was very strong amongst professional investors, hitting record levels, whilst implied volatility for S&P options was fairly valued, making call options look attractive. But outside of the Dow Industrials, the rally has been relatively anemic. The Nasdaq 100 has been held back by some of the mega cap tech names gapping lower last month, whilst the basic target for the S&P 500 was a 200-day moving average, around 4,100 on Wednesday when we filmed this before the FOMC announcement. The point here is that the contrarian case for a rally was starting to build a few weeks ago. However, what really matters is whether the contrarian case for a rally could become a full-blown bull case for the equity market. And for the US, this will probably depend on the outcome for employment, for which the housing and construction sectors could be key. So far, the employment outlook has remained relatively tight. Now, this data is notoriously backward-looking and will probably be revised higher in future. But for now, the jobs market has not decisively weakened. And in the past, we have argued that the jobs market might be tight, but it's not particularly strong. And this is because real wages were generally rising at a slower pace than prices. And that's contributed to the cost of living crisis. Indeed, many small businesses and the medium household have probably been in a recession for some time. But the overall US economy has not. Yes, it has had 2 consecutive quarters of negative real GDP growth, but the 2 quarters definition of a recession is a European definition. The US National Bureau of Economic Research definition is less clear-cut. They're looking for signs that a period of slowing growth has depth, duration, and dispersion, with dispersion meaning that the slowdown reaches most parts of the economy. And so far, the slowdown has been relatively narrow. Many large corporations have not yet been affected, and employment has remained sticky. But why does the employment outlook matter for equities? Well, it's because there's a relatively clear relationship between unemployment and recessions. Unemployment surges through a recession. Now, this is largely coincident, but the majority of the rise in unemployment has historically taken place through the main part of the recession. And rather than a full recession, the slowdown we've had so far in 2022 is really a price shock and a financial market adjustment to inflation and interest rate expectations. This is not the slowdown that you've been looking for. For the bears, the true recession, if it's going to happen, should still be ahead of us. But also, why should the bears care about a recession? Well, that's because US equities have made a major low either during or after the main part of each recession since 1950, on every occasion. And even when the equity sell-off has been relatively muted, like 1980 and 1991, the equity market low was still during the recession. Therefore, if the equity market lows are taking place at this moment in time, either we're already in a proper recession and therefore future GDP and unemployment revisions will have to be fairly sizable in order to backdate a true recession to this current period, or if and when the true recession occurs, we will get price action from the equity market that will need to be markedly different to the price action experienced during every single recession since the 1950s. If the recent lows are indeed the major lows, then equities will need to rally through the next recession, or we need a sizable rally from here so that if we do get the typical equity price action during the next recession, the market makes a higher low than today's lows. And we do have an example of that. The 1980 lows were not breached by the 1982 lows, though it was fairly close. But also, why should rising unemployment lead to weaker equities? Well, that's because rising unemployment leads to redemptions and liquidations. Loss of income or fear of future loss of earnings means that households sell down assets to generate cash. And this is often indiscriminate and accompanies the rise in unemployment. And that's why we often get that disorderly low in equities during a recession as unemployment picks up. So far, the combined losses in the equity and bond market have been absolutely huge. But the impact has not yet been realised. And that's because many of these losses will have implications for future returns, but may not yet be as apparent for households today. Household equity flows have only just turned negative, having registered inflows during the first half of 2022. Households have not yet really turned bearish. The bears are in the ranks of the professional community or the retail traders. And here we should make a distinction between retail trading, which has increasingly utilised huge volumes of very short-dated options, and general households who passively accumulate assets and have automatic allocations via things like 401ks. These flows usually take a hit when unemployment significantly increases. And as we've seen, this has not yet occurred. Of course, there is also the possibility that we don't get a true recession at all. But that would require the employment data to remain extremely strong. But there are now a number of headwinds on that front that are beginning to emerge. The huge year-on-year increase in mortgage rates, which in percentage terms is the fastest on record, admittedly, starting off a very low base. But that's beginning to bite into the housing market. Home buyer sentiment has understandably taken a hit. The NAHB housing index has dropped as quickly as it did into the GFC and COVID crises. Now, although mortgage prices have been significantly higher in the past, it's the rate of change that matters. Mortgages that have moved to 7% from 2% are far, far worse than mortgage rates at 7% that have come from 15%. And the real issue here is less about house prices per se and more about the slowing down of activity in a sector that employs a significant number of people. A drying up of demand will lead to a reduction in headcount within the industry. And the trucking industry is also starting to see a reduction in headcount as volumes fall and the industry readjusts back down from the excesses of goods demand during the COVID era. Additionally, many tech firms are cutting back, and startups who were able to fund excessive headcount when rates were close to zero are now having to balance the books by shedding labour. And wage discussions are also on the rise. Many payment negotiations are seeing inflation-beating demands materialise. And these will start to erode corporate margins that many companies have maintained by passing on higher prices to customers, whilst keeping real wage increases in negative territory. If margins are under threat, corporates tend to reduce headcount. It therefore appears fairly certain that unemployment is going to rise, and that would suggest a recession, which in turn implies that we should expect future weakness in the equity market. But can we get a bounce first? And if we did, can it go far enough so that if a real recession emerges, the lows are already in place? Now, this may sound pretty obvious, but this will depend on sequencing. How quickly will unemployment meaningfully pick up? How quickly will the Fed pause or pivot? And we'd recorded this before the FOMC, so the views here are about the longer-term relationship between the economy and inflation. Can the liquidity outlook turn up before unemployment begins to bite? And if it does, will that have dangerous implications for a rebound in prices? Policymakers are currently looking at ways to improve the liquidity of the Treasury market. Improvements in the bond market should help support other risk assets. But what supports the equity market could also support inflation. And currently the market has decided that a pivot could be as simple as a slowdown in the trajectory of rate hikes. Now, whilst a declining rate of change in rates is welcome, rate hikes are clearly not a pivot. The rate of change has to slow at some point, but neither is a pause a pivot. Historically, the Fed has generally pushed interest rates in excess of core inflation before they've started to cut. That requires the inflation data to drop back rapidly from current levels, or they are going to have to tighten more than the market currently expects. And this is where the dirty dancing really takes place. If the Fed softens their stance too early, then a rebound in expectations could prevent prices from dropping quickly enough to allow the Fed to truly pivot. The risk is that an early pivot would push up longer-term inflation expectations and longer-term yields, creating the potential for more pain in assets that price off the long end of the curve. Therefore, the Fed probably needs to see more weakness in the real economy before they feel they can cut rates. That requires unemployment to go higher and ISM manufacturing to drop decisively below 50. ISM new orders minus ISM inventories suggest that a bigger slowdown is coming, and the Conference Board CEO Confidence Index has dropped to recessionary levels. But so far, companies have continued to hoard employees, and that makes the Fed's job a lot harder. Turning into a tight labour market could lead to a recurring pattern of price peaks that were seen in the 1940s and then again in the 1970s. So credibility is key. And as we've mentioned before, if the market keeps pricing in the pause or the pivot, then the Fed has less need to reverse course and may even be emboldened to go harder. The longer-term bull case probably requires a very rapid deterioration in the real economy. The short-term bull case is largely sentiment-driven, and that contrarian argument is pretty strong at the moment. But remember, the active managers who are bearish are no longer in control of the majority of assets. That baton was handed to the passive community, which includes rule-based funds like risk parity, and they don't do sentiment surveys. The active managers have already hedged themselves, and that has been one of the major reasons why this equity market and its declines have been pretty orderly so far. But we've not yet seen household capitulation. Meanwhile, others have pointed to the relatively subdued VIX as an indication of a bullish setup in equities. However, we should be very wary of that. In 2008, the VIX dipped below 20 a few weeks before the market collapsed and volatility exploded higher. Spot VIX is a very poor predictor of future returns. For 2022, it has been better to buy the market when the VIX has been high rather than low, because that has usually been coincident with the dips. Equity volatility is also subdued relative to bond, represented by the MOVE index, and FX volatility. But volatility usually spreads from bonds and FX towards equities. That hasn't really happened yet because the decline in equities has been relatively orderly. The VIX around 25 reflects the actual volatility of the S&P 500. Call options are around fair value when compared to the price moves in the underlying market. And that's why institutions have still been intent on hedging an underweight equity position and may now be looking at the big December expiry on the 16th of that month, 2 days after the final FOMC meeting of 2022. Prior to the FOMC meeting this week, the 4,200 calls were offered at an implied volatility of 22.5, though a rally to that level of 4,200 requires the S&P to break the 2022 downtrend. Also, the pullback in the dollar has also helped generate a rebound in equity markets. But regardless of what the Fed does, the outlook for the ECB and BOJ is one which should continue to dilute their own currencies via yield curve control in Japan and printing cash for the energy crisis in Europe. A longer-term pullback in the dollar requires the Fed to hit the brakes because the economy is coming off the rails. If they hit the brakes before the economy has come off the tracks, then they risk boosting inflation once again. It's such a tightrope that they're walking. In many ways, the best outcome would be for the real economy to deteriorate fast enough for the Fed to properly reverse course before risk assets have a chance to react too negatively. But that sequencing would also require a significant slice of luck. In reality, we should probably expect the real economy to deteriorate more slowly into 2023 before unemployment picks up as that recession rolls in. And historically, a decline in equity markets would accompany that. But the key question is, from what starting level? Obviously, I'm evolving our outlook as the markets and data also evolve. In the next section, I talked to Kelvin Tay of UBS Wealth Management to get his views on how this outlook could develop and how it might differ from my own. Kelvin, great to see you. Thanks for coming on the show. And what I wanted to get into on this is really, we've just seen this very impressive kind of move in the Dow over the last month. I think the best in 50 years. We've had a rebound in GDP. In the first 2 quarters, the slowdown was quite anemic anyway. And we're seeing employment in the US still quite strong. So the question here, I guess, that people start to ask is, are we actually going to get a recession in the US? And if so, when should we think it's going to happen?
Well, I think for this year, the chances of a recession is actually very, very slim. But for next year, I think the odds of a recession happening in the US actually goes up to about 60 to 65%. And that's the market actually putting its odds on a recession happening in the US. But nonetheless, even if you don't have a recession next year in the US, the conditions, the situation next year will pretty much feel like you're in a recession. You probably have the unemployment rate rising, and we think it's going to hit about 4% by the end of next year. You will have a tightening of liquidity situation. We think that the terminal rate for the Federal Reserve is going to hit about 5% by the end of the first quarter of next year. And the bond yields will remain prohibitively high at about 4%. So when you combine those factors together, even if you don't have a recession by definition, the conditions will suddenly feel like you're really in an economic slowdown.
And is that because what we've seen in some ways already this year is that whilst we haven't been necessarily in a classic defined recession. It's actually, we probably have seen a recession in some small businesses and in maybe the median household in the US. And is it going to continue because I'm guessing inflation will remain slightly stickier, that it's still going to be a problem for that cost of living crisis?
Absolutely. Talking about that, if you look at core inflation, which is what we are obsessed about, right? Core inflation has been very, very strong. And in fact, in the last couple of months, it has actually been rising. Right now, it is at about 6.2%, which is way above the Federal Reserve's target of about 2%. Now, if you go back to the 1970s and 1980s, Paul Volcker, when he was the Fed chairman, raised rates up to about 20%. And despite that, it took a while for inflation to come off. And even when it came off to about 4% only. And that's only when the unemployment rate was at about 10.5%. So we're very far from the kind of situation at the moment. So I do think that where the Federal Reserve is concerned, it has some more room for hikes to actually continue. And if you're talking about the markets and why are they, suddenly, rebounding so quickly, like, you said earlier that the Dow Jones has had its best month in the last 50 years, it is largely because the market is actually hopeful that in the event of an economic slowdown, that the Federal Reserve will perhaps actually start to slow down or perhaps even stop hiking at the moment. I don't think that's going to happen. If you have to put inflation together with slowing growth and you have to ask yourself, which one is the priority? Inflation is certainly the priority, because if you have very high inflation, that's going to eat away into your returns where growth is concerned, no matter how high growth is, right? And it's just going to exacerbate the situation. So the Federal Reserve will have no choice but to make sure that inflation comes down to its target first. And as I've said before, it took a long time for Paul Volcker to bring inflation down, and I don't think it's any different this time around.
And in terms of that, where we could see inflation going, I mean, do you think that inflation will rebase to a higher level? Do you think that the central banks in general, not just the US, but generally, will eventually accept a higher base level of inflation? But do you still think it takes a long time to get to those sorts of levels?
Absolutely. One of the key differences between inflation now and inflation in the late 70s and early 80s is that now it's pretty much multifaceted, and it's the labor market that's actually driving it. I mean, I'm sure you know that in the US and in Europe in particular, the baby boomers are now starting to retire, which means that you have a smaller working age population. And of course, when you have a smaller working age population, that can only mean one thing, that your wages will rise. And wages is a very, very big determinant of that. So unless you can actually somehow engineer a huge growth in the working age population overnight, inflation is going to remain quite sticky. So I think in the next 12 to 18 months, policymakers will have no choice but to actually rethink their assumptions for inflation. And perhaps one of those assumptions will be that it may not necessarily be at 2%. In fact, it could actually be at 3%. Now, another point to note is that we've been fortunate this year that China is in an economic slowdown. Can you imagine what the demand for oil and gas would be, and where oil and gas prices would be like if China was actually growing at 5.5%? It will be stratospheric, right? And inflation will on a headline basis will be a disaster for all of us if that was the case, actually.
So with that, I mean, there have been these rumours today. This is Tuesday, where we've been hearing sort of comments that maybe China is preparing itself to open up. Now, there's two elements to that. One is obviously there will be demand for particularly energy. Will there be, on the other side of that, an opportunity to maybe unlock some of the supply chain issues that have been a problem over the last 18 to 24 months? So will it be two-sided? But I guess, is energy the one that really matters in this equation?
Yeah, I think it's two sides to the coin, actually. China opening up will mean a greater demand for oil and gas. And China basically buys a lot of its oil from the Middle East as well as from Russia, oil and gas. If that's the case, that means that they're actually competing with all of us for oil and gas, right? Because the Europeans are no longer buying from Russia, they have to buy from the Middle East as well. And likewise, myself in Singapore government actually buys from the Middle East too. So the demand for Middle Eastern oil is just going to go sky high, which means that the gap between WTI and Brent will actually widen even more from here. Now, the flip side is, like you rightly pointed out, the supply chain issues will be largely resolved. And if they're largely resolved, that in turn actually helps inflation. But I would point out that the difference between now and before is that it's basically the labor market that is responsible for most of the increase in price, not on the global supply chain side. I think the supply chain side has actually eased quite dramatically in the last 6 months. But on the supply of labor front, that still remains very, very intense. Unless we can increase our productivity overnight, or we get more working age people coming to the market, those issues are not likely to be resolved overnight. It's a structural issue in that sense. But of course, with China opening up, that means that demand will be better, will be stronger. And if that's the case, perhaps the world might actually avert a technical recession next year. But you know what? I'm not putting my money on that one, actually.
And on that sort of equation, a lot of people have sort of said that the power is still with the corporates. And in fact, some people have said that one of the problems for inflation that we've seen is that corporates have been putting higher prices through. It's not been the unions this time, even though wages are going up. And in fact, prices have been pushed through at a faster pace than wage increases. So margins for a lot of particularly old world companies have remained relatively wide. Do you think that's the problem? And if corporates do have that power, and in the US people have said there's too little competition rather than too much, too little capitalism. Do you think that's another reason why the Fed will have to kind of almost still beat down on these big corporates so they eventually stop passing these higher prices through to consumers?
You're absolutely right. I mean, that's a great point. If you look at the world in the last 20 years, right, we have actually been gearing towards big mega corporates. And these guys have pricing power. So no matter how high the wages go up, they can actually increase the price of the goods and services, and we have no choice. We have to suck it up, right? I mean, if you don't use WhatsApp, what can you use in the UK? Tough choice there, right? I mean, just as an example, not 100% applicable, but you know what I mean in that sense. So we're now being dominated by a lot of these mega companies, and that's not healthy. It is in fact a problem with capitalism. Instead of engineering, instead of the free market engineering more competition, competition has actually become less intense, and therefore these guys have a lot more pricing power. And that's, again, another reason why prices are being very, very sticky.
And so just adding sort of all this together, but really looking at maybe just the two biggest markets out there, very tricky to time all this. But in this framework, let's look at equities. Should we still think that equities will be volatile into next year? Because it's when you see unemployment pick up and potentially households liquidating, some of their holdings and 401k flows slowing down. Is that when we should be looking at probably the big bottom in the market and sometime maybe into next year?
I think the equities market is going to be very weak for quite some time for two reasons. Firstly, where the S&P 500 is concerned, about 30% of its earnings is actually derived from overseas. So with the dollar being so strong, that's going to hurt the earnings of these companies, right? So that's the first negative. The second negative is that when you have rates at about 5%, assuming that it peaks at 5%, your earnings growth is going to be affected. So we're looking at an earnings growth of about $2 per share, 2% for 2023 for a lot of the corporates there. And that, to me, is actually on a high range. We haven't talked about quantitative tightening. If quantitative tightening comes in a bigger way, your yields go up to about 4.5% where the 10-year treasury is concerned. That is going to be expensive for a lot of the corporates to actually refinance where the bonds market is concerned, right? So when you put all that together, that only tells me that earnings growth next year in the S&P 500 will be quite weak. And that in turn means that you're not going to see a re-rating of the equities market, because even though the S&P has actually rebounded in the last 2 weeks, it is trading at about 17.5 times earnings, which is still expensive. The 20-year historical average is 15 times. And why am I looking at 20 years? I have to look at 20 years because the 20-year average is a period where you had very high interest rates and very low interest rates as well. Looking at it on a 5 to 10-year basis is not going to tell you the full picture. So 20 years is actually a more accurate reflection of the valuations. And if you compare it to the 20-year valuations, the S&P is actually expensive. So what does that tell me? It tells me that there is room for the equity markets to actually come off.
And then finally, sort of the bond market is this one where we're always trying to work out, when a yield's going to peak and which part of the curve should start to come back first. Do you think that this is the Fed will eventually sort of, because of this inflation being sticky, will stay sticky at the front end, but eventually back end should start saying, growth slowing, and therefore those back end yields should come down before the front end? Is that how you'd play that?
Yeah, I think you're absolutely right. At this point in time, it's the short end of the curve that's actually doing really, really well in terms of the yields going up, because of the fact that, Fed fund increases of interest rates always affect the front end of the curve first. But I think over the medium-term basis, and I'm talking about 6 months here, when the economy really starts to slow down, unemployment rates start to rise, then I think bond investors will have no choice but to take a longer-term outlook and basically seek shelter in I would say anywhere between the 5 to 10 years in that sense. Then you'll start to see the 10-year actually bond yields actually sliding and the bond prices going up. So even at this point in time, I would actually be tempted to actually put, let's say if I want to invest $100 into the US Treasuries market, right? I would actually now start with at least 30% in the 10 years and probably gradually build that up towards the end of the first quarter of next year.
So basically on what you're saying there is there's still room for another shock potentially from CPI, from inflation, but even if we get that sort of shock, the reaction function from the central bank, from the Fed, is such that it will drive a slowdown in 2023, which will cause a reaction from the back end of the curve.
Absolutely. You know, to me, the Federal Reserve has no choice but to actually induce a recession to actually slow the employment market. And it's clear. You know, it's like when some patients have a head injury or coma, the doctors, what they do is, if you have swelling of the brain, they try to induce you into a coma so that you can actually rest, so that the swelling of the brain goes down before they take you out of the coma. This is the exact situation we have. Now, one point that I forgot to make earlier on with regards to inflation is, why is the labor market in the US so tight? It is not just the demographics. Back in 2008, when the global financial crisis actually happened, the baby boomers couldn't afford to retire because their pensions, which were stuck in the 401k, collapsed. And on top of that, the housing market collapsed as well. So they had negative equity if you look at the balance sheet. When 2020 actually happened, the Federal Reserve and the US government stimulated in a massive way. Equity markets recovered, bond markets recovered, and on top of that, the housing prices actually recovered. The average price of a median house in the US back in December 2019 was about 300,000 US. That same house is going for 428,000 today. Now, you tell me, is there any reason why the baby boomer would not retire? Don't forget that demographic is most vulnerable to the COVID-19 pandemic as well. And on top of that, the vaccination rates amongst the demographic is also amongst the lowest in the US. So these guys actually leaving the market, and they're not coming back because they're getting older. And it's going to be very hard to persuade them to actually come back into the market. So that's one of the reasons why the US is actually short of workers at this point in time. Plus the tighter immigration policies in 2016 introduced by Donald Trump at the point in time. And that's it. You put the two together, labor market is extremely tight. So you need to induce a recession to bring the demand for labor down, unless you can actually overnight increase your productivity, which is almost impossible.
Brilliant. So 2023 looks like it could be yet another interesting year. We've had a couple of them on the trot now, but another tricky one to navigate.
I think it's going to be hard. I think it's going to be challenging. And to be honest with you, I think this year is probably more challenging than 2008. In 2008, at least the bond market was actually breathing. This year, it has been completely suffocating. Everything is down. And you can't escape it because of the fact that you have high inflation, so interest rates are high. When interest rates go from this level to this level in a very short period of time, nothing survives in that sense. So we're all being suffocated here. Hopefully next year will be a little bit better. We can actually breathe a little bit better, but it doesn't mean that we're all likely to actually go out and be screaming for joy where the market's concerned. I think it's going to be a little bit of a downer where that is concerned.
Well, Kelvin, that's great. Thanks very much for that, and good to speak to you.
Thank you very much, and I'll see you next time.
So as you can see, there are lots of similarities between our views, but there are also a number of key additional points that Kelvin made. And perhaps the main one will be the speed with which China reopens, and whether that creates additional competition for important energy commodities. And Kelvin suspects that the inflationary outlook will remain challenging, and a very limiting factor is how quickly the Fed can actually cut rates.